video 2, chapter 7, we're going to look at the direct write-off method. The direct write-off method, okay? We'll do the rest of the videos after this, but we'll just do the direct write-off in this one. You can do the direct write-off method if it's lending is small amount relative to the business. So for instance, a mortgage company, they make loans. A bank, they make loans. Can't do the direct write-off method. But a company that doesn't make loans, doesn't have accounts receivable, fine. No, credit card, whatever it is, it's fine as long as they don't have the receivables, okay? They can do that. If they do have a lot relative to the business, then they can't do this. So this could happen. It's not that it's not allowed, it's just that it's not allowed for, people that are companies that do a lot of accounts receivable. And I named a few, right? Banks for sure, mortgage companies, finance companies, companies that do a lot of accounts receivable. You guys get the idea. All right, so all you do, if you find out somebody's not going to pay, and life happens. Good companies, good people, bad things happen to them, they can't pay. Just the normal things. Business goes under, health reasons. I'm not going to go into it. You guys get the idea. So then there's just some shysters out there that just never intended to pay. There's just bad people. We make I came from a lender, so you make loans to good people. Hopefully your internal controls and procedures prevent making loans to bad people, fraudsters, shysters. Okay. All right. So bad expense is debited and accounts receivable is credited. That's it. And it's a direct write-off, and that concludes the video. Just kidding. Let me show you the journal entries, okay? Oh, and then let's go ahead and deal with this now. Let's just deal with it now. Let's say you write it off, and then the direct write-off method, or even what we're going to show you, this probably the most preferred way because most people that do accounts receivable really do a lot of it. Let's say somebody, after you write it off, somebody says, you know what? I'm in good shape now, or a company says I'm in good shape, we're in good shape now, we're going to pay our debt. So we'll look at that too, all right? So the direct write-off method, the examples are the best way. So we got Dexter Company, Dexter determined it can't collect $45,000 from accounts receivable customer, and they write it off, the direct method. Debit, bad debt expense, and credit accounts receivable. So we have a bad debt expense recorded that's going on the income statement, and we're taking the $45,000 off of the balance sheet as an account receivable. Miraculously, out of the clear blue, Dexter collects from Lester. Dexter collects from Lester. Is that right? Yeah, okay. Anyways, this sounds funny. All right, so this is the entry. We put the accounts receivable back on the books. So we debit account. We do the opposite of the March 11th entry. So look at this. Accounts receivable is debited and bad debt expense is credited. So we just flip over the March 11th. So March 11th, that's how we write off bad debt. Usually that's the end of the story. Okay, I come from a lender, so I'm telling you right now, that's usually the end of the story. But sometimes, and this is just a beautiful thing, because this is just pure profit. That's all expensed. Everything going back on now is pure profit. We already expensed it. All right. Usually it's months, maybe years later. So it's really been a while. It's usually not, 18 days later? But anyway, that's the way the problem's written. So we're running with what the problem said. So a debit accounts receivable, 45 debit. Credit bad debt expense, 45, just like I showed you here. And then we record the collection of the receivable just like we normally would if the account had never been bad debt, never gotten behind. We debit cash, credit accounts receivable. And that's it. And then in the next video, we'll start looking at the allowance method, which is follows the matching rules, and I think it's safe to say it's the preferred method. Direct method is allowed, again, when it's small relative to the business. So it's a very small part of the business. The business just every once in a while does account receivable, or if they do it more than just every once in a while, it's just a real small, almost immaterial part of the business. All right. Well, It is immaterial to the business. Whether they do accounts receivable or not, it's just not a material item to the business. Whether it's collected or not, it's not a material amount to the business. So it's really small. All right, so that concludes this video, and then the next video will wrap up the allowance method.